In Chapter 9, we discuss business income, deductions, and accounting methods. The objectives will be discussed throughout the videos. Let's start with business income and deductions Schedule C, which is the form used or the schedule for a sole proprietor reporting trade or business income. It includes both the revenue and the expenses, and the revenues are from selling a service or a product. And we also report gross profit, which is the difference between the sales revenue and the cost of those goods. Business income does not include any items that are excluded by Congress, as well as deferred income, because the deferred income, by definition, will be delayed and reported in a later taxable year. In order for deductions to be able to reduce the income, they have to be directly connected to a business activity. Code Section 162 of the Internal Revenue Code states that deductions must be both ordinary and necessary for the business to help generate a profit, and they must be reasonable in amount. The example here is that Rick pays his brother Ben for working for him in his business. Ben's paid $45,000, but any other employee would have been paid $30,000 by Rick. So what is Rick's business deduction for employing his brother Ben? The reasonable amount would be $30,000 rather than $45,000, which is deemed to be extravagant. And so this would be deemed to be ordinary, necessary, and reasonable in amount to the extent of $30,000. The extra $15,000 is a gift from Rick to Ben. Expenditures against public policy are not allowed, so Congress does not want to help fund the payment of fines, penalties, bribes, lobbying, political contributions, and other types of expenditures. Also, if the expense relates to tax-exempt income, then the expense itself is not going to be deductible because the income is going to be exempt. So if the taxpayer has the benefit of not having to report the income and pay taxes on it, Congress is not going to allow them the benefit of being able to deduct the related expenses. Two examples given here are interest expense on a loan. If you borrow money to make an investment, and that's on municipal bonds where the interest income is not taxable, then the interest expense will not be deductible. Similarly, if the company pays insurance premiums to insure the life of one of its major or key employees, if the employee passes away and the company is a beneficiary, the company would receive tax-free life insurance proceeds. Therefore, Congress will not allow the deduction of insurance premiums to buy that tax-free policy. Capital expenditures are not currently deductible, and that's because they will be deducted over their life. Personal expenditures are not deductible unless Congress makes an exception, and then there's also a business interest limitation. For capital expenditures, if the expenditure is going to benefit more than a 12-month period, then instead of expensing it, we capitalize it, which means we make it an asset. We debit an asset account, and then we will expense that over its life or as it's used up, as the value drops, as far as utility to or usefulness to the company, or with the passage of time. There is a rule, an exception called the 12-month rule for prepaids. If a taxpayer prepays an expense, they can actually take the deduction in the year they made the payment if that benefit is less than or equal to 12 months and if the benefits don't extend beyond the end of the next tax year. This rule does not apply to interest expense, however. In this example, Ben is a cash basis taxpayer and he makes a payment on June 30th, $10,000 for 10 months of utilities, $12,000 for insurance coverage for 24 months, and $9,600 for 8 months of interest on a business loan. Which amounts are deductible? Well, we'll see that because the $10,000 paid on June 30 will last for the rest of this year, which is 6 months, and then 4 months into the next year, it's all deductible because it's less than 12 months. The $12,000 for insurance over the next 24 months is going to have to be set up as a prepaid, and then just the amount of the insurance that has expired can be expensed. So $12,000 divided by 24 months is $500 a month. So Ben will be able to deduct 6 months, July through December of this year, even though he paid for it all this year. And then the other 6 months, or the other 18 months actually, next year, because he is not able to deduct it over all the 24 months because it cannot extend beyond the end of the following year. Lastly, the $9,600 for 8 months of interest, $9,600 would be divided by 8, and then we would take 6 months of that to determine how much can be deducted. So all of the $10,000 utility expense can be deducted, and just $3,000, which is 6 months at $500 for the insurance, because it's a benefit that exceeds the 12 months in the 12-month rule. And then the 12-month rule does not apply to interest, so he can deduct the $7,200 for interest, because that is the 6 months of interest expense this period. Again, if something is a purely personal expenditure, there is no deduction on a person's tax return allowed, unless Congress makes an exception, because perhaps they want taxpayers to support charities, nonprofit organizations, or they want them to be able to take care of their medical costs. A mixed motive is one in which there's a personal element and a business purpose element. And so some of the costs have to be allocated between personal and business, and only the business portion deducted. And then as far as business travel, it's an all or nothing. So for example, we'll see on the next slide that there's some airfare paid. If the primary motive for traveling to a particular event is business, then all of the airfare will be deductible. If it's primarily a personal motive, even if there is some business portion, none of the travel expense or the airfare will be deducted. Record keeping is very important. The taxpayer must keep what's called contemporaneous records, and they must be written. So contemporaneous means current. You keep that record going as time passes and as business activities are encountered. The example of travel is that Ben pays airfare to go to a business meeting in Chicago, and he stays in a hotel for 3 nights and then has meals as well. So if 2 of the days are spent in meetings, then 2 of the 3 days makes it primarily business. But if only 1 day was in a meeting related to business, then it would be 2 days personal, which is primarily personal. So this chart shows that if it's primarily business, then all the airfare is deducted, whereas if it's primarily personal, none of the airfare is deducted. Note, it's not prorated, it's just all or none. Now the hotel and meals are prorated, and just the business portion can be deductible. And note that for meals, even though it would be $90 a day times 2 days, it was primarily business, that's $180. It still is limited to 90 here because only 50% of meals can be deducted. And that's because Congress realizes that there's a personal element to meals, whether it's for somebody eating away while they're on a business purpose, a business trip, or for purely personal reasons. Something new is the business interest limitation. This is new with the Tax Cut and Jobs Act of 2017. For businesses that are large, which means that the average annual gross receipts for the past 3 years have been $25 million or more than $25 million, they are subject to this rule. But for businesses whose average annual gross receipts in the 3 prior tax years are $25 million or less, they are not subject to this rule. The reason that there's this cutoff is because large companies who meet this definition have a greater opportunity to decide how they want to fund their business. Do they want to fund it through capital or through debt? In other words, do they want to sell stocks to investors and make them part owners, or do they want to borrow money? If they choose to borrow money, the amount of interest expense on that debt is limited. And if it's a smaller company, They may not have opportunities to issue stock. They might be a closely held small business, and so therefore they may be needing to borrow money if they need to fund their operations, and so there is no interest expense deduction limitation. Whatever their interest expense paid is the amount that the small businesses would be able to deduct on their tax return currently. So for large businesses, the business interest expense deduction is limited to business interest income. That means their interest expense is limited to the interest income that they've earned plus 30% times their adjusted taxable income. So it's not 30% times their taxable income, it's the adjusted taxable income. And that is defined as income that does not take into account interest income and interest expense, nor does it take into account depreciation expense, amortization expense, and depletion expense. And also it ignores net operating loss carryovers. Let's take a look at this. There's a company that reports $1 million of taxable income and the revenue was $50 million. So that's a large business with $50 million of revenue. Included in that $50 million was $250,000 of interest income. For the purpose of determining whether the business interest expense is going to be limited, we are to ignore the $250,000. So since it's in the $50 million, we would have to remove it, and we can just start with the $1 million of taxable income and make the adjustment accordingly. Also, the depreciation and interest that was deducted would have to be adjusted. So we're going to add that back in. So we can start with taxable income, which did include some interest income that we're removing, the $250,000, and it did take into account some depreciation and interest expense. And because that's not to be included in the adjusted taxable income formula, we're going to add those two expenses back in. So the base then is $700,000 times 30%, which is $210,000. And because this company also did earn some interest income of $250,000, we can add that in. So the answer here is $460,000. And what that really means is that the company can deduct up to $460,000 of interest expense in that year. If they cannot, they cannot deduct all their interest because it exceeds $460,000, they can carry that over to future years. There are losses allowed when a company disposes of business property. Recognized losses are deductible. And so one type of loss is casualty. A casualty loss is a sudden unexpected loss, such as from a hurricane, hailstorm, flood, theft, fire, etc. The loss is limited to the lower or the lesser of the decline in value or the basis, which is the amount that the business owner had invested in that asset. So it says repair cost here because if an asset, let's say, was worth $20,000 before the casualty and then it was worth $14,000 afterwards and somebody could pay $6,000 to restore it, they would be paying the repair cost to restore it back to the $20,000 value before the loss. The basis in the asset is used as the amount of loss if there's a total destruction of that asset. So let's say somebody owned an asset, a building that was had a basis of $80,000, but it was worth $200,000. If that's totally destroyed by fire, then the amount of loss is not the $200,000, it's the $80,000 basis, because that's how much the taxpayer had invested in that building. That's the end of video 1, and we will finish the chapter with a second video.